Thank you for joining, everyone. My name's Z Razak from GoldHouse Accounting. I'm the MD, and basically, we are going to be covering the fun of self assessment. I hope you got the agenda here. Hope everyone can see it. Thumbs up. Are we going live now across LinkedIn as well as Facebook? Excellent. So, a bit of background about me if you've not met us or seen us before. My journey to now, I've been working in accountancy, tax, and a financial director roles for the last 20 odd years for some well reputable organizations like Santander, Mothercare, Connaught, which is big in property. I've been running the accountancy tax advisory practice for the last 8 years called GoldHouse Accounting. Done a fun rebranding. Hope you love the rebranding. One of the recent achievements was quite humbling. We got onto old Sky TV. There's me recording stuff, trying to give some expertise around property, businesses, and tax. And that's going to lead us nicely onto what this is about. So if you check on the agenda, what we're going to do is the common issues people have and things they miss when they're doing their self-assessment. We're going to be focusing on 23-24, which is now due. If anyone hasn't done theirs, January 31st is the deadline. I know it's a bit scary, but it's worth getting it out of the way, and I hope you guys enjoy the tips. We are going to share these across the piece. My team are working around the clock on this. They're going to help relay this info, and hope you enjoy all the value. Thank you for joining us. For me, first big area is property income. I'm going to start with the common issues. What a lot of people have is they've struggled to report what this property income is all about, and miss a lot of opportunities. One of the biggest issues I find when I look at property income on self-assessments is people don't struggle to understand what is repairs and maintenance. So I'm going to just run through that for you guys and ladies who are watching. Repairs and maintenance is a common big problem area. Repairs and maintenance is where you literally do repair and maintenance. I'll give you an example. If I've got carpet, the first time I buy it, believe it or not, I can't claim it. It's considered something called capital. Remember that, and I'll explain to you what capital does later in the show. Repair and maintenance is if it gets damaged and I replace it, then I can claim it as an expense on my self-assessment under repairs and maintenance. This is really important concept because this affects everything. Same if I buy a kitchen for the first time, if it's not replacing an existing kitchen, then it's capital, and therefore I can't claim it. But if I'm replacing an existing kitchen, and the thing that you've got to watch out for, is it like for like? Is it the modern day equivalent of what you're buying? And that's where you've got to get an evaluation done from an accountant, tax advisor, if you're not sure yourself. Because that repair and maintenance could be quite big, reduction in expense, and reduce your profits. But if you get it wrong, you may have a nasty, hefty tax charge for getting it wrong. And this is where you need probably some advice just to make sure, does this qualify or it doesn't. The other bit that a lot of people struggle, especially with the changes a few years ago, is replacement goods such as washing machines, white goods. So if I replace a washing machine, depending on the value, and provided it is not more than what I initially had my original, I can claim that. And there's a section on the self-assessment as replacements. However, if it's more, I can only claim what I originally paid, and this is where people are like, really? Yeah. Or if I bought it for the first time, I can't claim it because it's not a replacement. And this is so important, and these are the common issues, but they can be quite huge because obviously the amount of money you're spending. So I wanted to cover this. The other one is the dreaded mortgage interests. Unfortunately, good old George Osborne changed the rules a few years ago, and it's become quite complex because people don't realise that the mortgage interest for people who are earning over 50,270 at the time we're speaking is it's not fully tax deductible. You only get basic rate relief, which is currently 20%. So if you're a high rate taxpayer, you're having to pay tax on interest cost that you would have got full relief if you rolled the clock back a few years ago. This does mind blow a lot of people. So I'll give an example. This is probably the best thing. If I had a property, I had income, and then I had a property income which was, let's say, I had income from other sources like employment of 50,000, and I had property income less all my expenses excluding mortgage, and it's 10,000, and the mortgage is 10,000. I'm just giving an example. Previously that would have been zero. Now what happens is that £10,000 can't be offset directly. So for that 10,000, because from 50,000 to 60,000 I'm a higher rate taxpayer, I'm actually paying 40%. So £4,000 worth of tax. £10,000 profit excluding mortgage interest, but I only get a 20% relief of that 10,000 mortgage. So I only get £2,000 off. So I'm actually paying additional £2,000 worth of tax. Previously it would have been zero. This is the thing that mind blows a lot of people, because they're like, I haven't got the money in the bank because I still had to pay the mortgage. So this is why you need to really be quite savvy and get good tax advice around how do you set up your income and your tax affairs to make sure you're trying to benefit and understand what the implications are. Because mortgage interest now can become a much bigger liability than they were previously. I want to cover some of the reliefs. These are the fun bits. Common things that people miss out or don't understand. Something called rent a room relief. Currently, as we speak, £7,500, £625 per month. So what this, and husband and wife, is split £3,750, so you don't get 7.5 each. This income is totally tax-free if you claim it. You can only claim it on your main house. So if I've got my main house and I'm renting one of the rooms out, I've got a lodger, right, and they give me £625 per month income, I get the full deduction as tax saving, and I can actually report it by claiming this relief. Actually, below £7,500, you don't have to actually report it. Good practice to do it and claim the relief, but you actually get the relief by default if you know and you've actually claimed it. The issue is if it's, say, more than the 7,500, what happens is you can't claim your expenses. This relief is as if it's all your expenses. So if I got £10,000 for my spare room, all I will get taxed on if I claim this relief is £2,500. I hope everyone it makes sense to anybody. If you struggle any of this stuff, do drop a question in the comments at the end when we do a Q&A, and we'll go more. The other bit is property allowances. What is this? So if I've got not my main property, because in my main property, the house I live in lodging, I'll claim rent a room relief. If I've got another property and I get £1,000 worth of income, I can claim the property allowance. So you heard me right, you can get potentially £8,500 tax free if you do it properly. When you claim property allowance, please note that's instead of having to claim the expenses. So you've got to be really careful and clear on that. The third thing is something called, people forget, is called a mileage allowance. A lot of people don't realise, but if I travel to my property that I'm renting out, that I don't live in, there to travelling and back, I can claim up to 45p per mile for the first 10,000 miles. Bit of that extra value, if my wife or my partner is there as well, who also owns that property, we can actually claim 50p per mile, extra 5p. That's the first 10,000 miles, and if you do more than that, it drops down to 25p plus the 5p if you've got your spouse partner who's also part of the property business. The other bit a lot of people struggle is working from home. Please do check on how many hours, because they're quite stringent around this, but if I'm working using my facilities at home, I can claim allowance depending on the hours, and this can be anything up to £26 per month flat allowance. There is a more complicated way of claiming working from home where you do it as a proportion, but it's very dependent on how many hours or that you're using your office for this business per week or per month. So I would really have a look at that and see what that is, but it's a good way to claim for costs that you're anyway incurring. So my next bit, I hope you enjoyed the property income, employment income, common issues. This I could be here for a long time, just like property, but I'll do the common issues. When you work in a job and you get employment benefits, it sounds great news. My employer is taking care of me, and the employer is. But unfortunately, our government, HMRC, depending on what type of benefit it is, you can have the dreaded benefit in kind. And you have to understand that you're actually paying income tax on whatever value they associate with this benefit. And I've given you some common ones: cars, if you got a car through your workplace, private health, dental, the gym. These are not tax free. So you have to pay income tax, and your employer has to pay employer national insurance. A lot of people don't realize this, and they often get caught out on this. So really understand that. The bit that you need to know for self-assessment is if it's not taxed through your payroll, i.e. it doesn't come up on your wage slip, then you need to report it in a self-assessment, and they give you something called a P11D form, and that P11D tells you how much benefit you got, and you have to put it on your self-assessment. Often what we find is now they tax it through your payroll, and you don't need to worry, but you need to know that this could be an issue, and if they have undertaxed you, you'll get a fun letter through the post from HMRC. What I find is common things that you can potentially claim for, but people miss some of the reliefs that are missed. One of them is uniform allowances in certain professions. So you have to check, is yours a qualifying profession? You can Google this or get tax accounting advice, and they give you an allowance that you can put on your self-assessment, and the government will give you tax relief, and you could get a check back from in the post. Wow. Or even better, if you put your bank details on your self-assessment, they'll pay into your bank account. But please do check, do you qualify, and is it meet the criteria? There's a whole list by different professions. Working from home again, this has got more strict. In COVID, they were a bit more relaxed, and as soon as people started claiming it, it got more strict. You do need to check, are you contractually expected to work from home, and therefore use your home resources. Then you can claim, and there's two ways of doing this, through a flat allowance, which can be up to £26 per month, or what you can do is work out, depending on your rooms in your house, which are excluding your kitchen, bathroom, hallway, every other room, and what room you use for your office. Be careful that you do this wisely, because it could trigger something called capital gains tax. Always get advice. The other bit is mileage, and in this case, mileage in the sense, most people have, if you work for a company, a lower rate that you can claim, which isn't the 45p per mile, and it tends to be whatever car you've got, they give you a corporate rate. You can actually claim the one between. So imagine they say you can only claim 12p per mile through the employer. You can actually, on your self-assessment, claim the difference of 45p 12p. In that case, it would be 33p per mile on your self-assessment, and they will give you money back. Don't you love it? Kashing, bit of money back on your refund from HMRC. Don't you love it? The next bit I want to touch, employment income can go on for a while, but hopefully I've covered common issues and some reliefs. Self-employed income. Wow, where do I start with this one? This is sole traders. Technically, you should probably do sole trader accounts. A lot of people just whack it straight onto a self-assessment. But I just wanted to cover certain common things that people think. Not knowing what is tax deductible expenses as a sole trader. This is where I guess an accountant tax advisor can add huge value to your business, is make sure you're claiming stuff and claiming the right stuff. The issues are around the stuff you can't claim as well. People either miss the stuff they can claim, and they include the stuff they shouldn't claim. For example, the suit. I can't actually claim this suit, even though I'm not a sole trader, but if I was, I couldn't claim this, or golf memberships. Because the courts have decided, and there's a whole lot of fun around this, is something called duality. I.e., it's not wholly and exclusive for the business. There's a personal element, and therefore the whole of it is considered non-tax deductible. So please do check those. People often forget travel. I mentioned some of the stuff we're doing. So if I get a train ticket and I've got to go to a meeting, I can claim that. No question asked, because that's where I'm going. Obviously keep proof receipts and things like this. The one that's a bit more complicated for sole traders, whereas limited companies are a lot easier, is subsistence food. There's strict amounts and how I can claim it. So for a sole trader, I have to do, according to HMRC guidance, and I'm not a big fan of it sometimes. Sorry if you're watching HMRC, but in this case, it's well understood, and that is the benchmark, is I have to do overnight, and I can claim up to £25. That's including VAT. So if I spend on food £25 and I spend overnight, I can claim that against my taxes for my self-employment income. Some of the reliefs and tax deductible sensitive people don't count is a trading allowance. So if I've got a business and I've not made many sales, I can actually, and that's like less than £1,000 sales, someone's got like an internet business and they're just starting off, I can actually claim up to £1,000 worth tax-free. It's called the trading allowance, better known by many as the hobby allowance. The other bit is another thing, home office costs. This is quite interesting because under sole trader, unlike before, because it's a trading business, the mortgage interest is 100% tax deductible if you claim it, depending on how you do it. So a lot of value a tax advisor accountant can add there. Mileage costs, of course. The other one I put in there is staff payroll. I know it's a bit... Children over 13, you do need to check by council. You may need to get a permit. Provided they work for you, I'm being clear, they can actually, you can claim their payroll provided you paid them. There's different limits here, and this may change going forward. You can pay them up to a certain amount provided you can justify that without running payroll. Above a certain amount, which is called the lower earnings threshold, have a look, Google that. It's about 6,000 odd per year, over 500 odd quid. You would have to then run a payroll to put them on, and that could be, but it could be a good way of getting them involved in your business and saving tax, which is what it's all about. Next bit, I want to cover foreign income. This is probably one of the areas that people really struggle with, because foreign income can fall into so many different categories, and when you report it, you have to report it by country and what type of foreign income. And a lot of people are like, that's gone over my head, see, I ain't got a clue or the foggiest on this. Just a check. Oh, is everyone following us? LinkedIn, Facebook? Okay, cool. So one of the things that we have is not knowing different types of income, whether it's different types for income, whether it's interest income, dividend income. You would always have to check. Normally, you can find out. I would always recommend finding that out. Either include it yourself, if you're doing yourself, or get your accountant tax advisor to process it. It's quite hugely valuable. And also, people not knowing that they've got to report it. Believe it or not, that's one of the biggest issues. Because if you've got like a foreign bank account and you've been receiving mortgage interest, you may not even know. In year 23-24, there is some reliefs and exceptions. So if you've got foreign income below £2,000, you don't actually need to report it. You get a relief. Do need to check going forward, because good old Rachel Thieves, if I said that loud, apologies, but it's true. She may change it, but for 23-24, you're all okay. The other bit, this is where it gets a bit more trickier, and you do need to give advice, is double taxation treaty reviews with the country in question, and the UK is advisable in case the income is exempt in the UK. So some countries have double taxation treaties where if you earn income in their country, there's different thresholds and limits, and sometimes it can be almost tax-free. And that's where you've got to check. And there's some specific countries you may want to look at that can be really beneficial. So always get it checked. Pay for a bit of the advice, get it checked, unless you want to Google it and look at the double taxation tree yourself and try understanding it, around do you need to report it, and is there any reliefs from that country and the UK if you're doing obviously a UK self-assessment. Hope that makes sense. I thought I'd cover foreign income. The other fun that I'm going to touch base here is capital gains tax, CGT. Common issues. People ain't got the foggiest how to work it out, because it's not done the same way as income. Also, another big problem area is cryptocurrency gains falling into CGT and not income. So how capital gains tax normally works is that I have an asset, whatever the asset is, could be crypto, as I mentioned. I sell it, and whatever price I bought it for, and the gain, the difference, is called a capital gain in simple terms. And I pay capital gains tax. Currently, the limit ranges from 10 to 24%, depending on what the asset is. And that is changing going forward. Currently, property has a different threshold and different percentage charge, and that can range between 18 and 24%. Other assets were 10 to 24, but have changed due to the budget. And they're going to go, the 10 is going to become 14, then 18. And the higher one, I believe, has already changed. That's for 24, 25. So in the previous year, it was 20%. So if I've got shares and I'm selling them, I pay capital gains tax. Reliefs and exemptions and deductible costs. I want to cover this. In 23-24, this is a self-assessment. That's from 6th of April 2023 to 5th April 2024. I get a £6,000 annual exemption allowance. Really important. So if my gain is less than 6,000, I pay no tax. Make sure you claim that. And a lot of people don't understand how that works. And remember, if I'm a husband and wife and I've sold a property, that means I get 6,000 each. Really important. I think I mentioned earlier capital cost in property, and I said remember that. So you're going to claim that against your property income. So when I put the new roof or extension on or capital items, you can when you sell it, but please keep your proof. So this is where software or having good records when you're paying stuff, especially for investment properties or even your main house, to be honest, I keep all the records because you don't know what you may do in the future to your house, and this is then deductible because your base cost is your cost that you bought the property for, your stamp duty, land tax, that also goes in, and the cost of renovating or adding value that you couldn't claim against your tax self-assessment returns. Now's the time. There is other rules, I think I mentioned previously, around when you report it, but this is purely on how it's reported in the self-assessment. The last bit that a lot of people miss is your legal fees, your cost and your legal fees, and stamp duty, land tax. That is deductible against your property sale, or if you've got any cost on selling shares or any other aspects, those costs can be offset against the gain. So make sure you do it and keep the support. If you struggle, make sure you get advice. I just want to hit crypto again. The reason crypto, normally money, believe it or not, is not subject to capital gains tax, but crypto, under the wisdom of the United Kingdom government, is treated like that. So you've got to be careful if you are selling a cryptocurrency like Bitcoin. So if I sell Bitcoin and it's gone up in value, which it has, I've triggered capital gains tax off. So be really careful that you understand that. I could lose 20 to 24%, depending if I'm a higher rate payer. So 20% up to 23, 24, and then 24% going forward post the budget. One of the things that you've got to remember is the special rules for crypto and shares. I'm just mentioning these. Hopefully you get a bit of value, because don't say Z doesn't like giving value. I should have added to the PowerPoint. There's a 1 day rule, a matching rule called 1 day and 30 days. So if I sell something and it's gone and I buy it back, I don't have to pay the gain. And sometimes people do this depending on timing. So be wise and be managing your tax position and get advice on it, because shares and crypto have this rule. I think I've covered quite a lot. I know we had a little later start, but hopefully that made sense. I'm going to get into the Q&A, and we're doing a little offer in the last bit. Got a Q&A section. Blast it, team. Have you got any questions coming up? So, I hope you found loads of value here. We're looking at some of the questions coming up and see how well people took all that fun. There's a lot of it. Okay, so the first question, how does mortgage interest affect your self-assessment? It's one of the biggest issues, especially if you've got property income. I think I worked through it and I gave a sort of example. Basically, you're not getting the full relief. As you go up the tax brackets, it's becoming painful. I would always get tax advice around how you can mitigate this. There's a few different ways of doing it, but it is painful, and unfortunately you're not going to get full tax relief if you earn more money. That's just unfortunately the way it is. Another question we got coming in, how does the mileage allowance work? I know I touched on it, but I'll sort of give a bit more insight. How it works is that when I travel, if I'm a sole trader, if I travel to a client or a business journey going networking, there and the return journey back home, I can actually claim the mileage as a tax deductible journey, and it's about obviously 45p per mile for the first 10,000 miles and 25p after. Brucey bonus, if you've got another member of a team and you take them with you, you can claim 5p extra if they're in your car. The next bit is the home office as a sole trader. Home office as a sole trader, as I said, there's a couple of different methods. One is a flat rate that can be up to £26 per month. You just need to make sure you're doing the hours and you can support it. And there's different amounts for different hours. Type in Google and it'll give you the rates. The other one is a bit more advanced and it could be quite beneficial. Is depending on how many rooms you've got in your house, you can split it across the rooms and claim a portion of all your costs, including mortgage interest in your house and against your business. So if I've got, say, my costs are £10,000 from my house and I've got 4 rooms, I can claim potentially £2,500 against my business expense if I've got a home office. I hope that makes sense. So because it's done by rooms. That's one way, really smart. Just be careful to manage capital gains tax. The other question I've got an eBay business. Do I have to pay tax? And if I do, what can I do to mitigate it? Great question. Don't know who the question was from, but anyway, the great question. So one of the things is, yes, you do have to pay tax. The government are clamping down on that fund. We've got £1,000 allowance that you can do. If you've got less than £1,000 of the sales, you can claim the trading allowance. You don't even have to do a self-assessment there, or can be called hobby allowance. If it's more, then you can either claim the £1,000 or claim the cost of running the business against it. You have to do the weigh up if it's worth it, because obviously if you do the proper accounts, you may need to get an accountant, tax advisor to do it for you. Can be beneficial, and they can go through it and make sure they claim everything for you, because that's the value. The other bit, how do I mitigate my capital gains tax when selling my business? Okay, that's a really good question. So love it. The way to mitigate your capital gains tax when you sell a business, if you've been running the business for at least 2 years, you can claim something called, it's a bit of a tongue twister, business asset disposal relief, better known as entrepreneur's relief. What happens is, if I'm a sole trader or I've got shares of a limited company, I only have to pay 10% on my capital gains tax, not potentially 24% going forward. And this is, you have to claim it, and you have to make that election, they call it, on the self-assessment. I would always recommend getting tax advice, but it could be huge, the benefit. So I hope that makes sense. Another question coming in, if I've got a commercial property which I run my business from, and if I sell it, is there any way to mitigate the capital gains tax? Great question. You can mitigate capital gains tax on the property, provided depending on what it was used for, and it's whether it's included in the business or not, by claiming what I mentioned, the relief. You can actually pay zero and defer for up to 3 years something called rollover relief. Really important. You have to meet certain criteria, get advice. If you're going to replace it, so I'm in this office and I imagine I owned it, I hope one day. If I sell this office and then I go and buy another one within 3 years to support my business, I don't have to pay capital gains tax, provided the office, the new one's more than the old one. If it's the same price, happy days. If it's lower, I just pay the capital gain on the bit in the between. So let me give you an example. If I had an office and it was worth $500,000 and I sold it, and the new office I go and buy is now $500,000 or $1 million, I don't have to pay no capital gains tax, provided it's within 3 years. If I go and buy an office worth $400,000, then the £100,000 is subject to potentially capital gains tax. And then you get reliefs and you try to obviously manage the exposure. But you're deferring it, it's better the money in your pocket than HMRC. What else have we got? Good question. If I've got commercial property that I just bought for my business and it happened to be a sole trader, partnership as well, is there any benefits? Yes, there is. So if the property, and I would always get specialist advice on this, can claim on the purchase something called capital allowances, right? You can claim that on the purchase against your taxable profits. Believe it or not, you have up to £1 million allowance that you can claim depending on what available capital allowances you got. So you could be earning a lot of money tax-free. One beautiful one. Don't miss that. Get expert advice from a property tax specialist if you know one, and they'll get a surveyor out to do that for you. Also, if there's any refurbishments. Right, okay, sorry. There's one here. What will be the capital gain tax liability when purchasing a semi-commercial property from a parent, and there are any leaves exemptions should be considered during the transaction? I think that's coming from Glenn. Is that right? So Glenn, you would have to review that. It depends on what that commercial property was used for. So if it was used for the business, there's two aspects here, by the way, two taxes. One is for, obviously on the self-assessment, is capital gains tax from your parent. They can claim the reliefs I've just spoken about if that was used for their business. If it's an investment property, they can't claim that relief. But when you buy it, you can actually, I know it's not part of this, but you can claim a special relief for stamp duty, land tax. So you've got to look at it both ways. Also, there is a third tax that you've got to think about, which is outside the scope of self-assessment, is inheritance tax. But it's worth getting an evaluation, Glenn, on this to make sure that you're looking at the full picture and you're getting the right advice based on your scenario. And obviously paying the right amount of tax, which is obviously the most beneficial to you. So if you need us to follow up, please do get into contact with us. We will have the contact links. I hope I've covered it, but it is very dependent on your scenario, what the asset is used for. Another question we've got is, if I think we covered that. Oh, this one's a good one. If I've got a furnished holiday let business, is there special rules? Love it. Yes, there is. These are actually, I did a post on LinkedIn on this actually. The good old Jeremy, the previous Chancellor, from up to April 25, furnished holiday lets or service accommodation, you use planning as well, as long as you've got the right planning class, they will actually meet a certain relief, i.e. you can claim entrepreneurs relief, i.e. business asset disposal, so you pay 10% tax, or you can do it as a replacement of asset. So there is a lot of reliefs in replacing the furnished holiday let at the moment. From April 25 onwards, if you sell it after that, unfortunately you won't get none of the reliefs. You can also claim the third one, which is called rollover relief, which I mentioned, where you can do a replacement, because the rules are based now up to April 25. So make sure you get really good advice on that. Great question. I think there's another question we got over here. Pension apologies. Is there special rules when it comes to income over 100,000, and do I have to do a self-assessment? Great question. Yes and yes. Yes, so if you over 100,000 got a bit of a dreaded tax there, it is basically that you have to pay 60% income tax. Wow. How does that work? Every £2 that you earn over the 100,000, you lose £1 off your personal allowance, that £12,570. So up to about 125,000, you lose it all. And in that period, so you're actually paying 60% tax. So the 100,000 is a bit of a cliff edge, and it's a very nasty tax. That's number one. And number two, because of this, you have to do a self-assessment. So if you're earning over £100,000, yes, you have to do a self-assessment. It becomes even more important if you got it from employment income or whatever types of income you got. Get good advice, take advantage of all the reliefs. Got another question coming through around child benefit. Okay, child benefit, really good question, love it. Up to 50,000 in 2023-24, you don't have to pay back the child benefit. But now let's use an example: husband and wife, or civil partners. Loads of different variations there. If you or your civil partner, or husband and wife, earn one of you earns over 50,000, they will start clawing back your child benefit. So between 50 to 60 grand, it will be literally clawed back. So if I've got two people earning 50,000 on the dot, no clawback. As soon as one person out of the thing, relationship, earns over 50,000, they start clawing it back, and you have to report it on your self-assessment. So therefore, you have to do a self-assessment and pay back the child benefit. Painful. Nice question. Actually, the next one is for 24-25, so 6th of April 24, it actually moved between 60 to 80,000. So it's gone up, and they are going to change it to make it allegedly more fairer, but I think it's going to become a bit more nastier, that it's not done on the individual. They're trying to do it that it's done on household income. I think that's very difficult, but they're going to try. The next bit is pension contributions. I don't know if anyone knows how pension contributions work, but still they're one of the best protections against income tax. What happens on income tax, really important, is that if you're earning over 50,270 and you've made a pension contribution to a registered employer's pension, you can claim back the higher rate relief against your income tax. So the government will give you money back. You just claim. So I'm going to give an exact number here. Imagine I've done a pension contribution of £2,880. That's 3,600 because the government uplifted it by 25%. I actually put that 3,600 on my self-assessment, and what happens is every pound I earn over 50,000, I get protection on the higher rate, which is actually another 20%. So I get a refund back. So paying into a pension can be really beneficial, especially as you go up the thresholds. So really important, check what your pension contribution is. It is down to you. Others will not do it. They will not claim it. The only exception is salary sacrifice. Your employer then does it on your behalf. It's quite efficient. But if you're in a normal pension scheme, they won't do it. And if you're high rate, always get it done. Either do your own self-assessment or get someone to help you. Great question coming up. If I move to Dubai, do I still need to file a self-assessment in the UK? Depends, right? So when I say that, it depends. If I'm working and I move to Dubai, depending on the date, so if I move between the tax year, you have to work something called split year. It's quite complicated, get an evaluation. But if I move on 6th of April 2025, I'm done with the UK. I've had enough. Rachel Thieves and good old Rodney really annoyed me. Everyone laughs when I talk about Rodney. I hope you watched on Fools and Horses. But anyway, that's our Prime Minister's middle name, just let you know. If they scared you off and you go on Dubai, then provided I meet the criteria and get an assessment done, I don't have to report my income in the UK, what I earn in Dubai. The exceptions, one of the exceptions is if I've got rental properties in the UK, that property income is from land and property in the UK. This is where it gets a bit tricky, is how do you do it? If I'm doing a self-assessment and I've got that agreement with HMRC, I can technically earn £12,570 profit tax-free in the UK and my employment is done in Dubai. If I earn more than £12,570 from property income, i.e. the profit, then it's obviously taxable in the UK. So I could have a situation where a lot of my income is in Dubai, not taxable in the UK, but the property is. Because in Dubai, you pay big fat 0 income tax. Don't you love it? Or 0 capital gains, 0 inheritance. I don't know how long that continued, but I love it. I've got another good question. That was a great question, by the way. Another great question come in about second-hand items. I think we've seen all of this in the press at the moment. Right. Number of reliefs. We mentioned the hobby allowance, the £1,000 relief on sales, because these eBay and etc. are dobbing you guys in, write them out. So going back to this, what I wanted to cover is that when you do a second-hand item, I would, and this is painful, I know, I totally support everyone on this. I don't know what they're doing, but they want to know, are you making money? If you do not keep your cost off your item and it goes over £1,000 worth of sale, you may have an issue because you can't claim the hobby allowance, i.e. the trade allowance. They have said a different threshold, but technically from a tax perspective, if you haven't got the cost and it's second hand, then you have nothing to offset. So this is where it's a bit of a nasty one, because the whole point of this was stop people who are buying goods and selling them, not you selling your second hand. But the problem is the government don't trust anybody, and they believe everyone's making a bucket load of money when they're selling their second hand socks. Don't know who wants to buy them, but they are. Alfie, you ain't sold no second-hand socks, have you? Okay, just checking. Or the second-hand cardigans, whatever it is. I've got a smile out of him there. Or even the second-hand Christmas hat. If you sell too many of these, imagine you sell you and your families. Recommendation, make everyone sell their own. Don't help them out, because they will come after you, because eBay will dob you into the government and they'll say, Joe Blogs or Z has sold £1,000 worth of clothes. And if Z hasn't got the costs to show that they were his goods, i.e. that he used or done, or his sons and daughters' love, let my wife know about that, she's much more eBay than me, he could or she could have a tax bill. So it is a bit of a nasty one, but be aware we are living in 2024, and in 2024 the government are hungry for your money for tax. Any more questions? I think we've covered loads. Any more questions? Facebook? LinkedIn? Everyone happy? We need to go back to our little offer. Can I share that? Share the screen. I hope you've seen the offer. We got a special exclusive offer at the moment. If anybody wants to need a review of their self-assessment, we will do, if anyone signs up and does the self-assessment with us and uses tax code self23-24, we will look at their last year's self-assessment for no charge and tell them if there's a chance of obviously claiming anything back. And if there is, obviously there's work and we will tell you accordingly, but you'll get a free review from myself and my team. So the offer is, get in contact with us. If you watch this, quote the self 2324. If you need us to do a self-assessment, this is by Tuesday, closing business 17th of December, because it is busy and I don't want to end up stressing my team out. They've got Christmas, New Year on. But if you had enough and you're like, do you know what, Z, don't want to do this, take advantage of this. We'll do your self-assessment this year. We'll quote you for it. We'll review the previous year and tell you, because you can amend it, by the way, by 31st of January 2025. That's the year before, and get money back from them if you missed any of my fun things that I mentioned. There's quite a lot. The money's better for you and pay your Christmas presents than HMRC. So recap, the offer that we got exclusively for the people who have made it to the end, all the hardcore people. You can contact us. There's our website. Our phone number is 01727 634444. You've got an email address that we didn't put on here, but it's info@goldhouseaccounting.co.uk, or go to our website on www.goldhouseaccounting.co.uk, and you can have us look into your self-assessment for you. We can quote you for this year's, which is 23-24, and if 22-23, we'll do a free review. Normally we charge quite a bit for that, and if there's opportunities on all those different things we mentioned, we could potentially claim back a hell of a lot of money for you. And if we do it, then we quote. So I hope that's been useful. Thank you for joining us. We're really humbled. I hope you really liked all the different values and the different ways to cut your personal tax down, because it's better in your pocket than HMRC's. Just the way it is. And I hope you enjoyed it, and I hope you join us for future LinkedIn Lives and Facebook Lives. Thank you so much.